Beijing is in full-blown panic right now. Not one, but two of China's biggest developers are on their knees and they're begging bondholders not to pull the trigger on a default this month. Vanke and Wanda, they're completely out of cash. Nobody is buying homes, and the entire economy is rolling over harder than anyone wants to admit. And Beijing's big response today? The strongest easing language we've heard in years. We're talking words, not actions. Now let me be crystal clear. When a government has to scream, we're going to go big on stimulus in 2026, at the same time, its crown jewel developers are hours from technical default, this is the most bearish confession you'll ever hear. This is no longer a property crisis. This is the opening act of a systemic financial heart attack that's going to slam commodities. It's going to crush supply chains, torch global risk assets, and almost certainly trigger the next financial crisis. And right now, your portfolio, it's in the blast radius, unless you're positioned correctly, because this is also going to be another one of those big wealth transfer events that most people will never see. Now stay locked in, because I'm about to show you exactly why the too big to fail names are cracking, how to protect everything you built, and how to straight up profit while everyone else panics. Plus, tonight's show is brought to you by Onco Innovations Limited. You can find them on the CBO ECN, the symbol ONCO, and on the OTC QB under the symbol ONNVF. And they're a trailblazing Canadian oncology company that's gearing up for phase 1 clinical trials next year, unlocking massive potential in the booming $500 billion global cancer market. Now stay tuned to the end of the show. Check out the pinned comment or description for more information. Because today's inciting incident, it's absolutely brutal, and it's happening right now. China Vanke, long considered the healthiest, most state-backed developer in the country, just had bondholders sit down with Shenzhen regulators in Beijing to get opinions on a one-year extension plan for a 2 billion yuan bond due on December 15th. And this is a textbook extend and pretend, because Vanke doesn't have the money today, and they're praying magically they do in the next 12 months. In fact, it's so bad that Vanke asked bondholders on Friday to accept a plan to delay paying a 3.7 billion yuan note that's due on December 28. And this is getting so serious that some hedge funds are now openly warning that a Vanke default would trigger systemic risk across the entire financial system because of how deeply tied it is to local government funding and the banks. So Beijing's got a choice. Either print trillions to bail them out, and that will destroy the yuan, or let Vanke go and risk a full-blown banking crisis. And on the exact same day, Dalian Wanda Commercial Management Group sought note holders' approval to extend the maturity date of an 11% dollar note to February 13th of 2028. We're talking over 3 years here. So this isn't isolated. This is contagion in real time, and it doesn't stop here. Now let's dive in, because they're actively hiding how bad it is. So let's roll back the clock to late November, because what Beijing did was nothing short of an all-out panic. The week after Vanke first asked for an extension, China's Housing Bureau told China Real Estate Information Corp and China Index Academy, which are among the country's biggest private property data providers, to suspend the combined sales of the nation's 100 largest developers until further notice. They weren't politely asked. They were ordered to hide the data. Now why? Because Beijing knows the November numbers were apparently so catastrophic that letting the public see them would have triggered total panic. And Christy Hung, a senior real estate analyst at Bloomberg, said it best. The missing housing data could increase uncertainty about the struggling sector's condition and would likely show steeper declines. Translation, the truth is so ugly, they had to bury it. Now we know October is already the worst monthly drop in 18 months, down 41.9% year over year for new home sales among the top 100 builders. And November had to be worse. That's why they killed the data. This is financial authoritarianism in real time. See, Beijing understands that if hedge funds, institutions, and the public were to see the real speed of the collapse, they'll dump every property stock, short every developer bond, and the entire system breaks within weeks instead of months. And the analysts who still have the data, well, they're screaming. Fitch Ratings warned last month that new home sales by area could decline another 15 to 20% before the sector stabilizes. The bleak outlook suggests banks' property-related bad debt will likely stay elevated next year. And UBS Group AG expects home prices to keep falling for at least 2 more years. So you've got Evergrande, Country Garden, they already blew up. Vanke, they were supposed to be the firewall. Instead, it's becoming the detonator. Now let's talk about the debt wall that nobody wants to talk about, because this is not a liquidity hiccup. This is a developer staring at multiple multi-billion yuan maturities every few months with zero realistic way to refinance or sell enough homes to cover. Even with state shareholders, there's only so much the banks can absorb before their own balance sheets crack wide open. And here's the kicker that ties it all together. On the exact same day Vanke bondholders walked out of that regulator meeting disappointed and wanted to file for their own extension, the political bureau releases their year-end statement vowing, quote, more proactive fiscal policy and, quote, appropriately loose monetary policy for 2026. Now, this is the strongest easing language we've seen out of Beijing in years. And the markets, and they're cheering like it's bullish. But when a government has to pre-announce massive stimulus a full year early while its crown jewels beg for survival, this is the definition of capitulation. This is not a dip. This is the moment the structural rot becomes visible to everyone. In fact, even the smart money is voting with their feet louder than ever. Bearish bets on China Vanke climbed to a decade high in Hong Kong of 25.1% of free float last Monday, as investors wagered that the downward spiral in the developer shares will extend following shock bond payment delay. That's a literal decade high. And S&P Global spells it out perfectly. The shorting surge is being driven by a combination of liquidity stress, looming debt maturities, collapsing bond prices, credit downgrades, and doubts about a government rescue. So you can see, the market no longer believes Beijing will or can ride to the rescue without completely destroying the yuan. And what happened? Vanke shares, they're already down 45% from February highs in Hong Kong. The sharks, they're not just circling, they're feasting because they think this name is going to zero. The PBOC, they secretly already know this is going to come crashing down. China's central bank added to its gold reserves for a 13th straight month, bringing the total to around 74.12 million troy ounces. So get this, the current buying cycle began back in November 2024. And what happened at that time? When things with the property developers first started falling apart. Now, some people say this is all about the strengthening dollar, it's just a hedge, because official sector buying allows countries to hedge against the dollar. So think about it this way. Gold allows countries like China to trade yuan for gold, and then later gold for dollars. And it's not about that. If China's property developers go down, and you can see it looks like that's going to happen next year, the banks are going down with them. And there's going to be massive capital flight. People are going to yank their money out of China faster than you can believe. In China, they're going to need something to prop up or be used to exchange for their currency, and in a big way. So they're not buying gold at all-time highs to hedge the dollar. They're doing it because they know their economy, their real estate sector, and their banks are on the edge of collapse. And when this happens, China is going to flood its economy with more stimulus. In fact, Morgan Stanley says the bill is so massive, they estimate that Beijing may need to spend about 400 billion yuan a year, that's right, per year, to lift the battered consumer confidence. And when the yuan inevitably weakens hard under the stimulus fire hose, every central bank on earth, they're going to get a massive deflationary shock. What we're looking at is the biggest macro catalyst for 2026, and almost nobody is positioned for it yet. Because when demand falls off a cliff, tide, it goes out everywhere. But for those who see it coming, this is going to be the trade of the decade on the short side. For the long side, all about hard assets. So here's what you need to do right now. I want you to stress test your portfolio tonight for China contagion. You want to look for commodities, things like copper, iron ore, oil, industrial stocks, luxury stocks, Australia-Canadian miners, emerging market funds. If it benefits from Chinese construction or middle-class spending, it's time to cut it back and hard. You want to raise cash and add short exposure if you can handle the risk. Because remember, Jeffrey Gundlach, he's the bond king. What did he recently say? A minimum of 20% of your portfolio in cash. Instead of cash, look to be long the dollar here, or perhaps short-dated treasuries. Because this environment, it crushes inflation expectations and says capital running to safety. That's what we're talking, the dollar and treasuries. And you want to be there first. Own the things that China's desperately buying. Think physical gold, gold miners, things with strong balance sheets, and Bitcoin. It's a digital escape hash here. And when the yuan cracks, hard money, it's going to come out big. So watch these dates like your financial life depends on it, because it's going to. December 10th, first Vanke bondholder vote. December 22nd, the second vote. Late January, Wanda note holder decision. If any of those get rejected, we get a technical default, and the dominoes, they're going to fall fast. And that's your catalyst for the next leg down in global risk assets. This isn't doom. This is preparation. Now, you know, I've been pounding on the table for years about this slow motion train wreck in China. Many of you said, Steve, you've been wrong. But we're now at the inflection point where structural rot becomes impossible to hide. Position now while still quiet. You look like a genius when everyone else is panicking in the first quarter. Now, let's turn to our sponsor of the show, Onco Innovations. You can find them on the CBOECN symbol ONCO and on the OTCQB symbol ONNVF. Everything you need to know in the pinned comment and description below. Because they're an exciting Canadian company that's all about fighting cancer with smart science and cool tech. They're combining breakthrough drug therapies that target DNA repair in tumors with super advanced AI to make treatments way more precise and effective. Imagine helping millions beat cancer smarter and faster. That's the vibe here. Now just look at their latest moves. In September of this year, they teamed up with Dalton Pharma Services to ramp up production of their star drug candidate, Onco10. This nanoparticle-powered therapy targets tough cancers like colorectal and is showing awesome results in animal studies, shrinking tumors, and boosting survival with paired with radiation. They're zooming toward FDA submissions next year. Talk about momentum. And the market, it's booming and exploding. The global oncology space is already over $500 billion, and precision medicine, exactly where Onco is mastering, is set to nearly triple by 2030. With colorectal cancer alone and an $18 billion opportunity, Onco is positioned to grab a big slice, especially with their AI platform predicting which patients will respond best. And get this, they're supercharging R&D with fresh partnerships. In the past few months, they've linked up with Kuano for AI and quantum computing to speed up drug tweaks, and with the University of Alberta for deep dives into hard-to-treat cancers. Plus, their Inca Health acquisition earlier this year brings Cinograph AI, which crunches real-world data to optimize trials and get therapies to patients quicker. With a powerhouse team of experts, including Nobel-linked innovators and top oncologists, Onco is building a dual platform that's scalable across cancers like glioblastoma and ovarian. They've got patents locked in, preclinical wins stacking up, and plans for global regulatory nods. This is a company on the rise, blending biotech smarts with AI magic for real-world impact. Now, compared to similar players, Onco's got that underdog edge with huge upside. Peers in early phases are valued way higher, and Onco's AI biotech combo sets them apart. They're not just dreaming big, they're executing with partners like Neurotechnics for tox studies and Advanced Clinical for trial prep. And their latest paper using real-world evidence, it shows how they're leading the charge in making AI insights regulatory ready, speeding up approvals and partnerships with big pharma. The future's looking super bright as they push toward those 2026 trials. Now keep an eye on Onco Innovations. You want to put them on your hot list, you can find them again on the CBOECN symbol Onco and on the OTCQB symbol ONNVF. With Onco Innovations, the sky is the limit. And as always with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do research before placing any trades and use your risk control levels when you do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.